Hi guys, welcome back to the next part of the online lecture on tax and subsidy. So now let's quickly use a numerical example to illustrate the usage of tax and how does it affect your supply curve. Alright, so first of all, we have your intersection of your demand and supply curve. Alright, and do note that all these are hypothetical numbers, meaning to say they are just for here for illustration. So let's consider this example, let's say beer. Alright, so the market price for a liter of beer is $16. Alright, and the quantity transacted is 240 liters, for example. So now, consider this scenario when the government impose a per unit tax on beer. Okay, so when there's a per unit tax of beer of $3 imposed, it could be a upward or a leftward shift. Alright, so you can actually, first of all, you can actually see that the new intersection, okay, of your demand and supply curve is at E1. Okay, and this in result you will have a higher equilibrium price and a lower quantity transacted. Okay, and second thing to note, alright, your parallel shift, okay, it is of $3. Can actually see that. Okay, this is a per unit tax of $3 that's imposed on the supply curve. Okay, so it's actually shifted upwards at every point of your supply curve. Okay, but normally we use a leftward shift. Okay. Okay, so we can actually see that with a tax imposed, alright, your equilibrium price goes up, okay, and quantity goes down, okay, because of highest cost of production. Alright, and there is a very specific amount that you need to find out, okay, and this amount is what we call your tax revenue. Okay, so for your tax revenue, how do we actually see it? Alright, first of all, we got to know the amount of tax that's imposed, which is $3. Okay, and the amount of units they are affected by your tax, okay, which is 170 units. Okay, so this area, this rectangle here, will denote the area, will denote the amount of tax revenue collected by the government. Alright, so you can actually, I'll go through I'll go through the ballpark figures very quickly. Alright, do not need to know all these numbers specifically. Alright, so initially before the imposition of tax, equilibrium quantity is 240, equilibrium price is 16. Okay, when you impose a tax, a per unit tax, okay, you will have a lower quantity and a higher price. Okay, and the total tax revenue, as I've highlighted to you, okay, is the new quantity times the tax amount, per unit tax amount of $3 per unit. Alright, so we will actually see that consumer and producer, okay, remember, okay, the tax is imposed on the producer. Okay, that's why it's called indirect tax. Alright, but the tax amount on consumer and producer can be split. Alright, meaning to say the producer can actually pass off the amount of tax to the consumer, okay, and they share the tax burden. Okay, and why is this so? Okay, we will want to look into the concepts of elasticity to find out more. Okay, which will be covered later. Alright, so what I want to highlight and showcase to you is, okay, no doubt the government collects $510 from the producer. Okay, but what happens is this tax burden, okay, can be shared with the consumers, okay, depending on the elasticity of demand, price elasticity of demand. Alright, don't need to know the figures in depth, okay, you just need to know the concept.